Look at your hand. Now, imagine a single dried up onion. No, a tulip bulb is worth more than a luxury estate in the heart of Amsterdam. And then, poof. It's worth less than the dirt it grew in. This isn't just history, my friends. This is the ultimate rollercoaster of human greed. Forget the boring lectures on monetary policy. Today we're diving into the moments when everyone, and I mean everyone, collectively lost their shirts. The times when rational adults decided that digital coins or exotic flowers were the best investment strategy. This is Wall Street Warlords, and these are the greatest market meltdowns in history. Our first stop is the Dutch Republic and Tulip Mania. These guys were the Silicon Valley of the 1600s, rich, innovative, and obsessed with status symbols. Enter the tulip. In the early 1630s, a common bulb cost about 1 guilder. That's roughly $15 today, enough for a nice lunch. But then the hype hit. By the peak in February 1637, a single Semper Augustus bulb was worth 6,600 guilders. That is $250,000 in today's money for a flower. You could buy an entire mansion, a coach, and a team of horses for the price of one bulb. Don't believe me? One famous trade for a single Viceroy bulb was settled for 2 lasts of wheat, 4 of rye, 4 fat oxen, 8 swine, 12 sheep, 2 hogsheads of wine, 4 tons of beer, 2 tons of butter, 1,000 pounds of cheese, a complete bed, a suit of clothes, and a silver beaker. Total value, about 2,500 guilders, the equivalent of decades of salary for a skilled artisan, all for something that dies in a week. The irony? Those beautiful flamed patterns that drove the price up weren't a result of brilliant breeding. They were caused by a virus. The Dutch were literally trading infected plants for the price of a kingdom. The crash didn't take months. It took 1 week. In February 1637, a group of buyers in Haarlem failed to show up at an auction. Panic spread like a virus. The bubble didn't just pop, it vaporized. Legend has it, a sailor once mistook a bulb for an onion and ate it with his herring. It was the most expensive breakfast in history, costing his captain a fortune and landing the sailor in debtor's prison. The aftermath. It was the birth of the speculative bubble. While it didn't collapse the world economy, it invented something we still use today, futures contracts. The Dutch accidentally created modern derivatives because they were too impatient to wait for spring. It proved that human nature is the one thing the market can never truly regulate. Next stop, the Roaring Twenties. If the Tulip Mania was a weird fever dream, this was a decade-long bender. The crash of 1929 is the undisputed heavyweight champion of meltdowns. For 10 years, the US stock market was on a high so intense it felt like gravity had been repealed. It was the era of the shoeshine tip. Legend has it that Joe Kennedy, yes, JFK's father, realised the end was near when a boy shining his shoes started giving him stock tips. Kennedy figured that if the kid with the brush knew as much as the man in the boardroom, there was no one left to buy. He cashed out, saved his fortune, and the rest is history. The cause. One word, margin. You could walk into a brokerage with $10 and buy $100 worth of stock. The broker lent you the other $90. It's like buying a house you can't afford, except instead of a roof, you owned a piece of a company that made, well, radio parts. RCA, Radio Corporation of America, was the Nvidia of 1929. Its stock went from $85 to $500 in a year. No one cared about profits. They just cared about the price. Then came the margin call. When prices dipped, brokers demanded their cash back instantly. Since no one had the cash, they sold their stocks to pay the brokers, which drove prices lower, which triggered more margin calls. It was a mathematical suicide spiral. Things got so desperate that a group of the world's most powerful bankers, led by Thomas Lamont of JP Morgan, met on the floor of the exchange. They pooled their money and started buying stocks at high prices to show confidence. It worked. For about 2 days. Then came Black Tuesday, October 12th, 1929. The bankers' billions were swallowed whole by a market that had simply run out of believers. The aftermath. Total annihilation. We're talking about a $30 billion loss in 2 days, more than the US spent on the entirety of World War I. This wasn't just a bad week for the rich. It triggered the Great Depression bank runs and 25% unemployment. How it was exploited. While the world burned, the boy plunger, Jesse Livermore, was shorting the entire market. He made $100 million in a single day, roughly $1.6 billion today. When he went home with a ham, his wife, thought they were ruined and had started hiding the furniture, so he walked in and told her they were now among the richest people on the planet. This crash didn't just break banks, it broke the American psyche. It gave us the SEC, the end of the gold standard, and a generation of people who hid their cash under mattresses because they no longer trusted the warlords of Wall Street. Welcome to the late 90s the dot-com bust. Bill Clinton is in the White House, Smooth by Santana is playing on every radio, and a new thing called the World Wide Web is promising to make everyone a millionaire before breakfast. This was the dot-com bubble, where the laws of economics were officially declared dead. The mania. Between 1995 and 2000, the Nasdaq rose 400%. The rule was simple. If your company ended in .com, investors would throw money at you like you'd found the fountain of youth. It didn't matter if you didn't have a product, customers, or, heaven forbid, profit. At the peak, companies were trading at 200 times their earnings. To put that in perspective, that's like buying a lemonade stand for $200 when it only makes $1 a year. It would take you 2 centuries to break even. But nobody cared about value. They cared about eyeballs. During Super Bowl 34, 17 dot-com companies paid over $2 million each for a 30-second ad. Most of them were out of business within a year. It was the most expensive funeral in marketing history. How it was exploited. While the dumb money was buying the hype, the warlords were cashing out. Mark Cuban is the legend here. He sold his company, Broadcast.com, to Yahoo for $5.7 billion in stock at the very top. Knowing a crash was coming, he used a collar strategy to lock in the value of his shares. When the market collapsed, Yahoo stock became worthless, but Cuban walked away with his billions intact. He literally hacked the bubble. The aftermath. By 2002, $5 trillion in market value had vanished. Thousands of companies went to zero. But here's the kicker. The crash was necessary. It cleared the zombies so the real titans could grow. Out of the wreckage of 2000, companies like Amazon survived and thrived. The bubble proved that while the valuation was a joke, the technology was real. It shaped the world by creating the high-speed, always-on digital empire we live in today. Just remember, the internet is forever, but your stock price isn't. Finally, we arrive at 2008 and the global financial crisis. This wasn't a crash in the traditional sense. It was a total systemic heart attack. This is the housing horror show, the moment when the world's safest bet, the American home, became a financial landmine. The cause? The subprime spiral. Wall Street bankers took thousands of mortgages from people who couldn't afford them, bundled them together like a giant financial burrito, and convinced the world it was grade A steak. They called these MBS, mortgage-backed securities. It worked as long as home prices went up. But when the teaser rates expired and the for sale signs started multiplying, the foundation crumbled. Imagine being a stripper in Florida, owning 5 houses and 2 condos, all on adjustable rate mortgages with no money down. That was a real story from the book The Big Short. When the market turned, those 7 properties didn't just lose value, they became anchors that dragged the entire global banking system to the bottom of the ocean. The moment, on a Monday morning, Lehman Brothers, a firm that had survived the Civil War and the Great Depression, filed for bankruptcy. It was the largest in US history. The world's plumbing froze. Banks stopped lending to each other because they didn't know who was infected with the bad housing debt, how it was exploited. While millions lost their homes, a few individuals saw the cracks in the dam years in advance. Michael Burry, a physician turned hedge fund manager with and a penchant for heavy metal, bet $1 billion against the housing market. He sat in his office for 2 years, losing money and facing lawsuits from his own investors, until the world finally caught up to his math. He walked away with $100 million for himself and $700 million for his investors. The aftermath. This event gave us the too big to fail era. The government stepped in with a $700 billion bailout, saved the banks, but left a generation of homeowners in the cold. It birthed the Occupy Wall Street movement, Dodd-Frank regulations, and, interestingly, Bitcoin, which was launched in 2009 as a direct protest against centralized banking, tulip bulbs, margin calls, internet eyeballs, and subprime mortgages. Different centuries, different assets, but the same human heartbeat. We are wired to chase the moon until the oxygen runs out. The next crash is already in the mania phase somewhere. It might be in AI, it might be in carbon credits, or it might be in a digital asset you've never heard of. But remember the warlords rule. The crowd is usually right in the middle, but always wrong at the ends. Hit subscribe, hit the bell, and stay liquid, stay classy, and stay rational.